In this video, we will reveal our top 7 candlestick patterns, going from basics to advanced patterns. We will also show you how to use these patterns in combination with price action to spot high probability trade opportunities. All in all, this is going to be a candlestick trading masterclass. A quick note before we start. If you are interested in our free training, click the link in the description to know more. It's free. And with that being said, let's get started. What are candlesticks? Candlesticks are just a simple way of looking at the historical price of the asset. Each candlestick represents the price movement of the asset for a particular period of time. So, if we are on a daily chart, a single candle represents the price action for one day. On the chart, we see two types of candles: green candles and red candles. A green candle is formed when the closing price is higher than the opening price. This indicates that the buyers were stronger than the sellers. Similarly, a red candle is formed when the closing price is lower than the opening price. It indicates that the sellers were stronger than the buyers. Now, the reason why most traders use candlesticks is because it gives us a better understanding of the price movement. A candlestick consists of two parts: the wax, or shadows, and the body. The end of the upper wax shows us the highest price achieved during that time. Similarly, the end of the lower wax shows us the lowest price achieved during that period. When it comes to the candle body, things start to differ. For green candles, the lower end of the body is the opening price, and the upper end is the closing price. On the red candle, the upper end of the body is the open, and the lower end is the close. Before we move on to the candlestick patterns, we need to understand a few concepts about candlesticks. Concept 1. Big versus small body. The body of a particular candle can tell us a lot about the strength or weaknesses of the buyers and sellers. For example, here we have two green candles. The candle on the left has a big body and relatively small wax. The price opened down here. Initially, the sellers tried to push the price down. The sellers were very weak as the buyers quickly came in and took the price higher. Then the buyers were able to travel a lot of distance without any pressure from the sellers. As a result, the price closed very near to the high. This shows us that the buyers were significantly stronger than the sellers during this candle. On the second candle, the story is different. The price opened here, and the buyers started to move the price. They raised the price to a new high, but at the high, the sellers stepped in and took the price downwards. The sellers were powerful and nearly covered the entire distance back to the opening price. But the buyers just about managed to close the price above the open. In this instance, we can see that the buyers were stronger than the sellers, but the difference between their power was insignificant. When the candle's body is relatively bigger than the wax, it shows that either the buyers or the sellers were in control. On the other hand, when the body is smaller than the wax, it shows that there was much less control from either side. It was a tough contest between buyers and sellers. Concept 2. Large wax. Whenever we spot a large wax above or below the body, it gives us a strong clue about the price action. If we spot a large wax above the body, it shows us that the sellers are strongly selling on these levels. For the price to move higher, the buyers will need a lot of effort. Similarly, if we spot a large wax below the body, it shows us that the buyers are strongly buying at these lower levels. If the sellers want to move the price lower, they must overcome these buyers. So the concepts of body and wax are essential moving forward. Keep them in mind as we begin to understand some basic candlestick patterns. If you're enjoying this video so far, then be sure to hit the like button and subscribe to our channel so you never miss any of our new videos. Basic patterns. Pattern number 1. Bullish pin bar. A bullish pin bar is a strong reversal candlestick pattern. It indicates a potential reversal to the upside. A bullish pin bar consists of 3 elements: a small green body, a large wick below the body, a tiny or no wick above the body. Let's understand the psychology behind this pattern. A bullish pin bar shows that the price opened around this area, and instantly the sellers tried to take the prices down. They were able to push the prices down, but at some point, the lower prices triggered buy orders from the buyers. The buyers were significantly stronger than the sellers, as they pushed the price beyond the open. Therefore, if we think about it, the buyers covered more distance than the sellers. It indicates that the buyers have stepped in, and they are trying to take the price higher. If a pin bar appears after a strong down move, it indicates that the sellers have lost their strength, and the buyers are now stepping in to move the price upwards. To trade the pin bar, we must look at other confluences to confirm our bias. We will discuss that later on. But if we find a buying opportunity as a pin bar, we can place a buy order above the high of the pin bar. We can set our stop loss below the pin bar and target the next resistance. Pattern number 2. Bearish pin bar. The bearish pin bar is just the opposite of the bullish pin bar. It is a red candle with a small body, a large wick above the body, and a tiny or no wick below the body. It indicates a reversal to the downside. The psychology behind the pattern is very simple. The price opened here, and the buyers started to move the markets upwards. They covered some distance and created this high. The sellers then get into the mood and push the prices downwards, crossing below the opening price. The sellers then manage to keep the price down, and the candle closes near its lows. This indicates that the sellers have momentarily gained an advantage over the buyers. If we find another confluence at this point, then we can place a sell trade below the low of the pin bar, and we can keep our stop loss just above the pin bar. Pattern number 3. Doji. The doji pattern is probably the only candlestick pattern that does not give us directional bias. However, it is essential to understand this pattern. A doji candle is characterized by a candle with approximately equal wicks above and below a small body. The open and close are somewhere in the middle of the candle, and the body of the candle is very small. It shows that the buyers and sellers were very competitive during that time period. The sellers tried to push the prices down, while the buyers pushed the prices upwards. In the end, they were both equal to each other, and the price closed near the open. In itself, the doji tells us nothing. It can indicate a momentary pause in the move, but if we see a few doji in a row, the buyers and sellers are battling for a win. Usually after such a pattern, the price will generally break out a wild move in either direction, so keep that in mind. The 3 patterns covered up until this point are a single candle pattern. Now we will move to intermediate patterns that consist of 2 candles. Pattern number 4. Bullish engulfing bar. A bullish engulfing bar is a 2-candle pattern where a green candle completely engulfs a red candle before it. This means we first see a red candle. Then, the next candle is a big green candle that completely engulfs the red candle. The high of the green candle is higher than the high of the red candle. Similarly, the low of the green candle is lower than the low of the red candle. The psychology behind this pattern is pretty simple. The sellers were in control during this red candle. Then, as the new candle opened, the sellers took the price lower. It broke the previous low, and suddenly the buyers stepped in. They overwhelmed the sellers and brought the price beyond the last candle's high. It shows that the buyers covered a more significant distance than the sellers. This means the buyers were now in control and ready to take the price higher. For the entry, we enter at the break of the high. We can place our stop loss below the low of the candle. Again, as I already said, we want to see other confluences like the price action to confirm the trade. Pattern number 5. Bearish engulfing bar. A bearish engulfing bar is a two-candle formation where a big red candle completely engulfs the previous green candle. We first have a green candle. Then the next candle is a larger red candle that completely engulfs the green candle. The low of the red candle is lower than the previous candle's low. Similarly, the high is higher than the previous candle's high. Let's understand the psychology of the pattern. First, we see that the buyers were in control as the price made this green candle. Then, as the next candle opens, the buyers try to push the price upwards. They manage to break above the high of the previous candle. Then, all of a sudden, sellers see these highs as an opportunity and they start to sell. Their selling pressure is so high that they manage to break beyond the low of the previous candle. The sellers traveled a larger distance compared to the buyers. Hence, the sellers have now grabbed control of the markets. So we can place a sell trade below the low of this candle, and we can set our stop loss above the high. Advanced patterns. Pattern number 6. Morningstar pattern. The Morningstar pattern is a three-candle pattern that indicates a bullish price reversal. The first candle is a strong red candle with a big enough body. The second candle is a doji or pin bar candle with a small body and large legs. The doji or the pin bar can be red or green. Then, finally, we have a big green candle that breaks above the high of the doji candle. The size of this candle will determine the strength of the pattern. If the candle is as big as the red candle, then it is a good trade opportunity. If it is smaller than the red candle, it is a low probability trade. Lastly, if the green candle closed above the high of the red candle, it is a strong reversal candle. The psychology behind the pattern is pretty simple. First, we have a red candle. This shows us that the sellers were in complete control of the markets. They pushed the prices downwards. Then, we see a small doji candle. It shows us that buyers have stepped in and are pushing the prices upwards. Soon, the sellers lose their strength, and the buyers take the prices higher, trading this green candle. It shows that the buyers have turned around the situation and are now likely to see an up move. To enter the trade, we will place a buy order above the high of the green candle. We will keep our stop loss below the doji candle. Pattern number 7. Evening star pattern. The evening star pattern is the complete opposite of the morning star pattern. Here we have a three-candle pattern, where the first candle is a green candle with a considerably big body. Then, we have a small doji candle with a very small body. And finally, we have a red candle with a big body. The psychology behind this pattern shows us that initially, the buyers were in control as they created this green candle. Then, soon enough, the sellers entered and started to challenge the buyers. As a result, we see this doji candle. The doji candle indicates that the buyers and sellers are in a tug of war. Then, finally, the sellers win the battle, and they start to move the price down. To enter a sell trade here, we place a sell trade below the low of this candle, and keep our stop loss above the doji candle. So these were the 7 candlestick patterns that can help you spot trade opportunities, but we are not done yet. We will now understand how to use price action concepts to find entries using these patterns. We will use support and resistance levels and trend lines to combine the candlestick patterns with price action. Here's an example. The price was in a downtrend, but it found support near this area. We see 2 reversals here and mark it as a support level. Then the third time, when the price arrived near the support, we expected to find support. But we are waiting for a candlestick confirmation. On the down move here, we see that as the price approached the support, the candles became smaller in size. This was the first sign that the sellers were losing momentum. Then, we see this doji candle form at the support, another sign of support. The doji is followed by a large green candle, indicating that the buyers had taken over the control and were ready to move the price. The green candle completed a morning star pattern. It was a strong pattern because the green candle broke above the high of the doji candle and the red candle before it. So a buy trade can be placed above the high of the green candle. We can place our stop loss below the pin bar, and we can target this high. As you can see, the price moved up after our entry. Even if you missed the entry, the price also gave us a second entry. The price made these two tops, creating a solid trend line. When the price reaches near the trend line again, we wait to see if the price develops some pattern. This red candle indicates that the sellers were trying to provide resistance at the trend line. The candle is followed by a large green candle that completely engulfs the red candle. It's a bullish engulfing candle. The low of the green candle is lower than the red candle. The high is higher than the red candle. Again, a very strong indication that the buyers have taken control, and the trend line is not strong anymore. A buy trade could be initiated here as well. We place a buy order above the high of the candle, and we place stop loss below the candle. Our targets will be these highs. As you can see, the price achieved our targets on this trade. Here is an example of a sell trade. Here we see that the price finds resistance around this area. Then, when the price tests this resistance the second time, we see it create an evening star pattern. We have a green candle, a doji, followed by a large red candle. The red candle is so large that it closes way beyond the lows of the previous two candles. Hence it is a high probability pattern. So we place a sell trade at this candle's low, and set our stop loss above the high. For our targets, we can target these two lows. And as you can see, the price achieved our targets. I hope you have now understood how to use these candlesticks for your trading. Again, the candlesticks alone are nothing. You need to combine them with other factors to create a trading system. You can head over to our website to get free training. The links will be in the description below. If you found this video informative, then be sure to hit the like button and subscribe to our channel to never miss new videos. See you soon. Candlestick patterns are one of the most important concepts when it comes to trading profitably. Yet you'd be surprised that most traders still use them incorrectly. The most confusing part about trading candlestick patterns is figuring out which ones actually work, since there are a lot of them. But here's the truth. 99% of these patterns don't actually work, and I know this because I've tested all of them throughout my trading career. However, I've found that a handful of them work extremely well, and to this day, have made me a lot of profit. In this video, I'll reveal the top 6 candlestick patterns proven to work, as well as everything you need to know about them. As a bonus, I'll also reveal how to combine these patterns with price action to find high win rate trade entries. And by the way, I've created a free guide which compiles all the high win rate patterns into one document. Inside, I show real trade examples of these patterns, along with some tips and tricks to increase their win rate. You can use this guide as a reference whenever you're trading. So, if you want access to it, you can pick it up inside my free Telegram community, link is in the description. Now, let's begin the video. First, what are candlesticks? Candlesticks are a simple way to look at price history. Each candlestick represents a price move of an asset for a particular period of time. For example, if you're on the 1-hour time frame, each candle represents the price history for 1 hour. If you're on the daily time frame, then each candle represents price history for 1 day. A common question I hear from beginner traders is, why shouldn't we just use line charts to look at price? Wouldn't it be simpler? The answer is that candlestick charts actually give us significantly more information about the market compared to a line chart. And let me show you an example. So let's use this euro-dollar pair as an example. On the left, we have the line chart, and on the right, we're using the candlestick chart, As you can see, both charts move in a similar shape, which is expected since they both display the price. However, notice that the line chart only shows us one piece of information, the closing price for each period. In contrast, the candlestick chart provides 4 pieces of information for the same time period. First, there's the open, which is the opening price for that period. Next is the high, which shows the highest price reached within that period. Then, there's the low, which is the lowest price reached during that period. And finally the close, which is the closing price. If you were to use only the line chart, the closing price would be the only information you get. To see this more clearly, use a comparison between a line chart and a candlestick chart forming. As you can see, the line chart only displays the closing price for each period, while the candlestick chart shows more information about price movements during the same period. So, what makes these extra information so important? As traders, this information gives us a better understanding of the market, allowing us to make more informed decisions. For example, let's say that price hits a support level and bounces. If we're only using line charts, the only information we know is that the price dropped to this point and then bounced off. However, when we switch to a candlestick chart, it tells a different story. The candlestick chart shows that, at one point, the price actually dipped below the support level, as indicated by the long wick, before moving back up and eventually closing at the key level. If we were using only a line chart, we wouldn't know this information. Details like these are crucial for price action traders because they can hint at where the price may go next. There are 2 types of candlesticks: green candles and red candles. A green candlestick forms when the candle closes above its opening price, showing that buyers were stronger than sellers. Similarly, a red candlestick forms when the closing price is below the opening price, showing that sellers were stronger than buyers. A single candlestick consists of 2 parts: the wick, also called the shadows, and the body. The end of the upper wick shows the highest price reached during that period, while the end of the lower wick shows the lowest price reached during that period. For the candle's body, however, things are a bit different. On a green candle, the bottom of the body shows the opening price for that period, and the top shows the closing price. For a red candle, it's the opposite. The top shows the opening price, and the bottom shows the closing price. When we look at the chart, you'll notice that candlesticks come in various shapes. Some have larger bodies, others have longer wicks on one side, and some have small bodies with short wicks. Each of these shapes gives us unique information about price movements, and understanding them is essential for price action traders to analyze the market more accurately. The first type is candles with big versus small bodies. The body of a candle can reveal a lot about the strength or weakness of buyers and sellers. For example, let's look at a green candle with a big body. This type of candle shows that buyers were much more dominant. This is because price opened at a lower level. But because the buying pressure was so high and sellers were weaker, buyers were able to push the price up significantly without much resistance from sellers. This is why the candle closes in this shape. Similarly, a red candle with a big body shows that sellers were much more dominant. The price opened at a higher level, but since sellers were stronger, they managed to push it down significantly with little resistance, moving the price sharply downwards before the candle closes. A candle with a small body tells a different story. A green candle with a small body shows that, although buyers were in control, they were very dominant, as sellers also put up a lot of resistance. The price opened lower, and buyers tried pushing it up. But since sellers were almost as strong, the price didn't move much and ended near the opening price. This is why the candle has a small body. Similarly, a red candle with a small body shows that sellers were in control, but not dominant. The price opened at a point above, and sellers pushed it down. However, due to either a lack of selling pressure or strong resistance from buyers, they couldn't push the price down significantly, which is why the candle closes in this shape. Second type is candles with large wicks. The size of a candle's wick also gives us valuable information about price action. For example, a candle with a long wick on the bottom side indicates significant buying pressure. This is because for a wick to be long on the bottom, the price must have moved down significantly at one point. However, before the candle closed, buyers were strong enough to push the price back up considerably. This is why a long wick below indicates strong buying pressure. For the complete opposite, a candle with a long wick on the upper side indicates strong selling pressure. This is because for the wick to be long on the upper side, the price must have moved up significantly at one point, reaching a high level. However, before the candle closed, sellers managed to reject this upper low and push the price back down considerably. This is why a long upper wick indicates strong selling pressure. The third type is candles with a small body and equal wicks. If a candle has a small body and equal wicks, it indicates that neither buyers nor sellers are in strong control. This is because both buyers and sellers tried to push the price up and down during this period, but neither side was significantly dominant, so the candle closed near its opening price. In this example, buyers had a slight advantage, as the candle closes green. However, their strength is still nearly equal to the sellers. Understanding the concepts of body and wicks is essential as we begin learning about basic candlestick patterns, so keep them in mind as we move forward. Now, I'm going to show you my top 6 candlestick patterns that I found to be the most effective. Number 1 is the engulfing pattern. An engulfing pattern is a candlestick pattern made up of 2 candles, a smaller first candle, followed by a larger candle of the opposite color. The key point is that the body of the second candle needs to fully cover the body of the first candle. There are 2 types of engulfing patterns. Bullish engulfing pattern, which when the smaller candle is red, and the larger candle is green. And bearish engulfing pattern, which when the smaller candle is green, and the larger candle is red. When you see an engulfing pattern on a price chart, it could signal a potential trend reversal. For example, if the price is in a downtrend and a bullish engulfing pattern forms, it may signal an upward reversal, meaning the price could go up. This is because the pattern shows that buyers have grown stronger, as seen by the large green candle pushing the price higher than the previous red candle, indicating a possible reversal. The bigger the second candle, the greater the chance of a price reversal. To trade this pattern, we should confirm other factors to support our bias, which we'll discuss later. However, if you see a valid bullish engulfing pattern form, you can enter a buy position at the close of the large candle, with your stop loss set at the bottom wick of the green candle. The same applies to bearish engulfing patterns. When a bearish engulfing pattern forms, it could signal a possible downward reversal, as the large red candle indicates that sellers have gained strength over buyers. If you spot a bearish engulfing pattern, you can enter a sell position at the candle's close, with your stop loss set at the top wick of the red candle. Pattern number 2 is the pin bar. A pin bar is a candlestick pattern made up of just one candle, characterized by a large wick on one side and a small body. There are 2 types of pin bar patterns. A bullish pin bar is when the candle is green, with a longer wick on the bottom. And a bearish pin bar, which is when the candle is red, with a longer wick on the top. When you see a pin bar candle forming in on a chart, it means that sellers initially took control, pushing the price down to a low point. But then buyers stepped in, rejected that move, and pushed the price back up before the candle closed. This shows that, while both sides were active, buyers ultimately came out stronger. Some traders might enter a buy position as soon as they see a bullish pin bar, but I prefer to wait for another green candle to form, confirming the trend. Once the trend is confirmed, you can take a buy position after the candle closes, and place a stop loss at the bottom of the pin bar's wick. The same approach applies to bearish pin bars. If you see one forming, it means that buyers initially took control and pushed the price up, but sellers ultimately rejected this move and drove the price back down before the candle closed. You can wait for an additional red candle to form for extra confirmation. Then, you can look for a sell opportunity with stop loss placed at the top or the pin bar's wick. Moving on to pattern number 3, which is the 3-bar continuation pattern. This pattern consists of 3 consecutive candles that need to form in sequence. The first candle should have a large body and be bigger than the average candle. The second candle is a smaller, opposite-colored candle that ideally shouldn't be more than half the size of the first candle's body. The third candle should be another large candle that closes higher than the second candle's close. There are two types of three-bar continuation patterns. A bullish pattern, where the first and third candles are large green candles, with a small red candle in the middle. And a bearish pattern, where the first and third candles are large red candles, with a small green candle in the middle. Whenever you see this type of pattern on the chart, it could indicate a possible continuation of the current trend. For example, if the price is in an uptrend and a bullish three-bar continuation pattern forms, it suggests the price may continue rising. This can be a good opportunity to enter a long position if you miss the initial uptrend, with a stop loss at the bottom wick of the second candle. It's the opposite for bearish three-bar continuation patterns. When you see it forming in the middle of a downtrend, it may suggest that the downtrend will continue. In this case, you could enter a sell position at the close of the third candle, with a stop loss at the top wick of the second candle. Moving on to pattern number 4, which is the three-bar reversal pattern. This pattern consists of a sequence of 3 candles. The first candle is large with a nearly full body. The second candle is smaller, has the same color as the first, and has a small body. The third candle is a large full-bodied candle, of the opposite color to the first two. The size of the third candle's body affects the success rate of this pattern. If the third candle's body is equal to or larger than the first candle, it suggests a higher success rate, and is considered a strong entry signal. If the third candle is smaller than the first, this suggests a lower chance of success, and is considered a weaker entry signal. There are two types of three-bar reversal patterns. The bullish three-bar reversal, where the first two candles are red, and the third is green, and the bearish three-bar reversal, where the first two candles are green, and the third is red. As the name suggests, whenever you see this type of pattern on a chart, it signals a possible reversal of the existing trend. For example, during the downtrend, if you see a bullish three-bar reversal pattern forming, it signals that the trend may reverse upward. To trade this, you can enter a buy position at the closing price of the third candle, and place your stop loss at the lows of the second candle. In the case of a bearish three-bar reversal pattern, it's the opposite. During an uptrend, if this pattern appears, it signals that the trend may reverse downward. In this case, you can enter a short position at the closing price of the third candle, and stop loss placed at the highs of the second candle. Moving on to pattern number 5, which is breakout candles. This is a type of candlestick pattern where we have multiple small candles with small bodies forming, followed by a large bodied candle. This pattern shows that the price was stagnant for a while, with no clear direction, until one side, buyers in this example, pushed the price significantly upward. In this setup, the series of small candles is called consolidation candles, and the large candle is known as the breakout candle. For this to be a valid pattern, there need to be at least 3 consolidation candles. However, the more consolidation candles there are, the higher the chance of a successful breakout. There are 2 types of breakout patterns. A bullish breakout pattern, where the breakout candle is green, and a bearish breakout pattern, where the breakout candle is red. Note that for both bullish and bearish patterns, the color of the consolidation candles is unimportant. What matters is that they're small in size. Whenever you see this setup on a chart, you'll usually observe a continuation in the direction of the breakout candle. Let's look at an example. Here, the price formed a series of small candles before a large green candle appeared, forming a bullish breakout pattern. This signals that the trend will likely continue upward. To trade this setup, you can enter a buy position at the close of the breakout candle, with a stop loss placed at the opening price of the breakout candle. The same principle applies to short entries. For instance, if you see multiple small candles forming as the price moves sideways, followed by a large red candle, this would count as a bearish breakout pattern. You could open a short position at the close of the breakout candle, with a stop loss placed at the opening price of the breakout candle. Pattern number 6 is shrinking candles. This is a candlestick pattern that consists of at least 3 consecutive candles of the same color, each getting smaller, followed by a large candle of the opposite color. This pattern suggests that the trend is gradually weakening, as indicated by the shrinking candles. Then, a large candle appears, confirming the reversal. The size of the fourth candle affects the likelihood of a successful reversal. Larger candles show stronger momentum, increasing the probability of a reversal. I recommend looking for a pattern where the fourth candle closes above the second candle. There are two types of shrinking candles: a bullish shrinking candle pattern, where the three shrinking candles are red and the fourth candle is green, and a bearish shrinking candle pattern, where the three shrinking candles are green and the fourth candle is red. Whenever you see this type of pattern on a chart, it signals a possible reversal of the current trend. For example, if the price is in a downtrend, and you spot three consecutive red candles, each smaller than the last, this signals that the previous downtrend is losing momentum. After that, a large green candle forms, showing that buyers are now more dominant, and signaling a potential reversal to the upside. If you see the setup on a chart, you can enter a long position at the close of the green candle, with a stop loss at the low of the previous candle. The same principle applies to bearish shrinking candles. For instance, if the price is in an uptrend, and you notice three green candles getting progressively smaller, this shows that the uptrend is weakening. Then a large red candle forms, ideally closing below the second candle, indicating that sellers are now in control, and confirming a reversal to the downside. In this case, you can enter a short position at the close of the red candle, with a stop loss at the high of the previous candle. So those are the 6 candlestick patterns that I found to work. Now, keep in mind, when traded on their own, these patterns may not always be as effective. However, if you combine them with other forms of analysis, like key levels, they can become much more powerful. So now, I'm going to introduce an advanced price action strategy that you can use alongside these patterns. This is the same strategy I use to achieve strong returns. To start, you'll want to prioritize higher time frames. Any time frame at or above the 1-hour chart is better. This is because candlestick patterns are generally much less effective on lower time frames. So, the first step of the strategy is to identify a key level on a chart. There are many types of key levels like support and resistance, dynamic key levels, trend lines, Fibonacci levels, and more. I won't discuss all of them in this video because it would take too long, but to keep things simple for this tutorial, we can start by finding support and resistance levels or trend lines. Here's an example. In this chart, we can see the price has formed a downtrend and reversed twice at a specific area, making it a level of support. Now that we've identified our key level, the next step is to wait for the price to interact with it once again. At this third retracement, we're expecting the price to bounce once more, but we'll need extra confirmation from a candlestick pattern that supports our uptrend bias. In this example, we see a large red candle, followed by a smaller red candle, and then a large green candle, which closes above the body of the first candle. If you remember from the patterns we've learned, this matches the characteristics of a bullish 3-bar reversal pattern, suggesting that the price may reverse to the upside. You can enter a buy position at the high of the third candle, place a stop loss at the low of the second candle, and set a take profit target at twice the size of the stop loss. As you can see, after our entry, the price moved up, hitting our take profit target. Here's another example. In this chart, we see that the price is in a downtrend, and it has formed a support-resistance level. This happens because the price initially formed the support level, as price rejected it once, but then price broke below it, and is now approaching it again from the bottom, making this an area of resistance. However, we also see that the price has made 2 lower high points, creating a strong trend line. This area where the trend line and resistance level intersect is called a confluence level, and the area where multiple key levels meet. Price is more likely to reverse at a confluence level. Now, we wait for the price to reach this confluence level. Once it does, we anticipate a reversal. We still need confirmation. Looking closely, we see 3 green candles, each getting smaller in size, followed by a large red candle. This pattern shows that, as the price approached our confluence level, buying pressure was fading, giving sellers the opportunity to step in. This is the characteristic of a shrinking candle pattern, which strengthens our expectation that the price will reverse downward from this level. This setup provides a good opportunity to enter short. Then, you can place a stop loss above the high of the previous candle, and set a take profit at twice the size of the stop loss. As you can see, the price moved down and reached our profit target shortly after entry. Now, if you've watched the tutorial this far, I assume you're one of the few people who are truly serious about learning how to trade. So, if you feel like you got value from this video, and want to learn even more, I've created a free guide that compiles all the high win rate candlestick patterns from this video into one file, which you can use as a quick reference in case you need a refresher. Inside, you'll find more in-depth explanations and trade examples for each pattern, along with 3 more high win rate strategies that I didn't show in this video. So, if you'd like access to the guide, you can pick it up in my free Telegram community, which I've linked in the description. Just go to the Files section, and the guide will be there. Inside, you'll also get access to my free market analysis on Forex and crypto, which I will be posting regularly. So, if you're serious about leveling up your trading skills, join the free community. I'll see you there. Do not take any trades unless you see this signal forms on your chart. The signal that I'm talking about here is called the first pullback, and in this video, I'll explain how you can use it to minimize losses while increase profits for every trade that you take. So without further ado, let's get into it. So, what is the first pullback? The first pullback is a highly predictable pattern that shows up in almost every trade setup. Here's how it works. Imagine the price is in a downtrend and begins to reverse into an uptrend. As we know, it's extremely rare to see a perfect V-shaped reversal when the trend is changing. What typically happens is the price starts to reverse, makes a brief pullback first, and then continues climbing. Now, this initial pullback after the reversal is what we call the first pullback. And I'm not exaggerating when I say this pattern is everywhere on the chart. What proof? Let's look at a couple of examples. Take a look at this Bitcoin 4-hour chart. The price was in a downtrend and reversed upwards. It then made a slight pullback first, before continuing trending higher. Here's another chart from gold, or XAU. This time, the price was initially in an uptrend. Then it began to reverse downwards, but it made a slight pullback first, before continuing downwards. Here's a chart from Apple stock. The price started off trending downwards. It then reversed upwards, made a pullback, and resumed upwards. You can find countless examples like these on any chart. Try it out for yourself after watching this video. So the main concept behind the strategy is to time the first pullback and aim to enter at around the end of the pullback. The key reason for this comes down to one crucial factor: risk to reward ratio. Let's break it down with an example. Imagine spotting a setup where the price was initially in a downtrend. Then, a strong buying pressure pushes it upwards. As a trend trader, you might see that the trend begins to shift and think about entering buy. But, buying immediately at the highs of the trend isn't the best move. Why? Because there's a chance that the price could pull back. Or worse, the uptrend could fail entirely. If you enter at the highs with a tight stop loss, the pullback alone could stop you out. And if you set a wider stop loss to account for the pullback, you'll end up with a much bigger loss if the trend fails altogether. This is exactly why waiting and entering at the first pullback is almost always the better play. At a pullback, you're getting in the trade at a more favorable price, which means your stop loss can be tighter. If the price keeps dropping after the pullback, that's a signal that the uptrend is invalid anyways, so having a tight stop loss keeps your loss small. But if the trend holds and price pushes higher, you're set to make bigger profits since you've entered in at a lower price. It's a win-win condition. You'll get smaller losses on failed trades, and much higher gains on successful ones. Now let's break down how to trade this strategy step by step. But real quick, I want to let you guys know that I also share trade signals completely for free. For example, just recently, I called that Ethereum was about to break out, and just 2 days later, it shot up nearly 5%. If you want to see more of my trades live, join my free Telegram community, linked in the description. Now, back to the strategy. The first step of trading the strategy is knowing how to identify a trend reversal. This part is absolutely crucial. If you mess this up, the trade simply won't work. Here's how to do it. So, one of the very first things traders are taught is how to spot uptrends and downtrends. If the price is making higher highs and higher lows, it's an uptrend. If it's making lower highs and lower lows, it's a downtrend. Simple, right? But here's the thing. There's a good chance you're actually getting this wrong. Let me break it down for you with an example. Imagine a chart forming higher highs and higher lows, clearly showing an uptrend. But then, something interesting happens. The price starts heading down and breaks a previous low. Here's where I see most traders make mistakes. When this low is broken, many assume the trend has reversed, thinking we are now in a downtrend. But what if I told you that this chart is still fundamentally bullish? Sure, the price broke a low, but this low isn't actually a valid one. Why? Because it didn't break the valid low, which is this one. Let me make this crystal clear. For a low to be considered valid, the price needs to break the previous highs after forming the low. In our example, the price never actually broke the previous highs, which is this one. Meaning the valid low is this one. So the price can do anything in this area. But as long as it remains above the valid low, this is still considered an uptrend. Now, let's take this a step further. If the price instead moves up and breaks the previous highs, this establishes a new high. In that case, the valid low shifts to the most recent low before the breakout. And for the trend to reverse, the price will now need to break this new valid low. Let's look at an example on a real chart. Here, we see the price forming higher highs and higher lows. And we can identify that the valid low is this one, because it broke the previous high afterward. Later, the price moves down and breaks this valid low. This break confirms a reversal since the price closed below the valid low. Keep in mind, it's crucial to wait for a candle to actually close below the valid low for it to consider it as a reversal. Once you understand how to identify a valid reversal, we can move on to the next step, entering at the first pullback. When we want to enter at the first pullback, we need to figure out where the pullback might form. This is important because pullbacks could form anywhere on the chart, and identifying the right area is key to timing your entry. From my experience, there's a specific area where the first pullback tends to form and bounce from, and it's called supply and demand levels. For those unfamiliar, supply and demand levels are areas where significant buyers or sellers have placed trades. The basic idea is that if the price retraces toward a supply or demand level, there's a high chance it will bounce from it, similar to how support and resistance work. So, if we can identify these levels on a chart, we can potentially predict where the first pullback will occur. The easiest way to identify supply and demand zones is by looking at the area right before a sharp price move. For example, if the price makes a sharp move upwards, the area before the rise is called a demand level. Similarly, if the price makes a sharp move downwards, the area right before that drop is called a supply level. Returning to our original example, you can spot this impulsive downwards move. To mark the supply zone, highlight the last candle before the impulsive move happened, which is this one. Use a rectangle tool to draw the zone from the candle's high to its low. This marked area becomes your supply zone. Once you've identified the supply zone, you can place a sell order at the bottom of the supply level, set your stop loss slightly above the supply level, and target a take profit level at 2 times the size of your stop loss. Alternatively, you can aim for the previous lows as your profit target. Now, let me clarify something. With this strategy, you're not entering the market at the current price. Instead, you're setting a limit order at your desired entry price, along with your stop loss and take profit levels. Once everything is set, just leave it alone, and let the price do its thing. The trade only activates if the first pullback happens, and the price hits your entry point. Like in this example, the price comes back, hits our sell entry, and bounces from the supply level, giving us a nice profit. But keep in mind, when using this strategy, there will be times when you face an order, but the price keeps moving without triggering your entry, and that's totally fine. Since no trade is triggered, you don't lose any money. The key here is to only take trades that perfectly aligns with our trading plan. If it doesn't, don't force it. Just stay patient and wait for the next opportunity. Let's look at another example. Again, the first step is to spot a trend reversal. And in this setup, we noticed the price was in a downtrend, and then started moving upward. But look closely. On this particular move, price didn't give us any clear lower highs or lower lows to mark, as the drop happens in one straight swing. So, how can we tell if this upwards move counts as a reversal, when there are no clear highs or lows to identify? This is where trend indicators come into play. While there are tons of options to choose from, I prefer the MACD because it's straightforward and reliable. So, let's apply it to our setup. Once the MACD is applied, we can use it to confirm whether this upwards move is a valid reversal. In this setup, we see that it crosses upwards at this point here. That's our signal that the reversal is valid, and that we are now on an uptrend. So now, we can move on to the next step, which is entering at the first pullback. To do that, we need to identify a demand level in this setup. In this case, we can see that the impulsive move upwards started here. So the first candle before the impulsive move is our demand zone. Next step is to place a buy order at the highs of the demand level. Set your stop loss just below the demand level, and your take profit targeting the most recent high. After that, we simply wait for the price to follow the trading plan. In this example, the price pulls back, triggers our buy entry, and then continues upward to hit our take profit. Now, even though this trade ended up being successful, you'll notice that the price experienced a slight drawdown and came very close to hitting our stop loss. But because we stuck to our initial plan and let the trade play out, the price eventually bounced, hitting our take profit. This shows why sticking to our initial trading plan is so important. Even with a slight drawdown, trusting the analysis and letting the trade play out can still lead to a win. That brings us to an important question. What if you can't identify obvious supply and demand levels on the chart? Well, there's another method that I use to find the entries on pullbacks without using supply-demand levels, which is using Fibonacci retracement zones. Essentially, it's a tool that automatically highlights key levels based on Fibonacci numbers. As you can see, the tool generates multiple lines, and price has the potential to bounce off any of these levels. However, one specific level, the 61.8% level, also known as the golden zone, is where price most commonly pulls back into. This is why it's often the most reliable area to watch. Here's how I use it. First, if I've identified a potential first pullback scenario such as this, I'll draw the Fibonacci retracement tool by dragging it from the lows of the move to the highs. Then, at the 61.8% Fibonacci level, place a buy order with a stop loss set slightly below the entry. For the take profit, I either aim for the previous high or target an even higher level, as these setups often have the potential to run significantly. Once everything is set, just let the market play out and do its thing. And as you can see here, price just barely wakes into our entry, then bouncing off, making this a successful trade. Now here's the exciting part. The concept of the first pullback doesn't just work as a standalone strategy. You can also apply it to your existing trading strategies too. For example, one popular strategy that complements the first pullback concept is the breakout strategy. I won't dive too deep into it here, but the basic idea is this. Price consolidates within a range for a while, and when it finally breaks out of that range, it often makes a quick sharp movement leaving us little time to enter. And if you do decide to chase the breakout and enter anyways, you're going to have a bad risk to reward trade. So, what I like to do instead is wait for a first pullback to form before entering. Once the breakout occurs and the trend shows signs of slight exhaustion, I'll apply the Fibonacci tool. Drag it from the lows to the highs of the breakout move. Next, I place a buy order at the 61.8% level. Set a stop loss slightly below our entry, and take profit at the previous highs. Now I'll simply let the price play out, and in this example, price retraced into the golden zone, hit our entry, and bounced off hitting our take profit, making it a successful trade. Now I cannot stress this enough, sometimes price may not even retest, and just continues running. You will miss a few trade opportunities using this strategy, but missing a trade isn't the same as losing one. Personally, I'd rather stick to high win rate setups rather than entering at a bad price, so learning techniques like this is great. But what if I just give you real-time market updates that you can actually profit from? Like in this example, I said that Ethereum would bounce from this area, and 2 days later, it was up 5%, or this one, when I told my subscribers to buy Tau, and 2 weeks later, it shot up 16%. So, if you want signals like this, join my free Telegram community, link in the description below. Again, it costs absolutely $0 to join, meaning it's free. If you found this video helpful, don't forget to like and subscribe. It only takes 2 seconds to do, but it helps the channel out a ton. Thanks for watching, and I'll see you in the next one.